Okay, I think we are live as usual. This is a sound test. If someone can hear me, then just type it and I'll know sound is working fine, although it does look like it's working fine from here. It seems to be working fine, but let me know in any case, and we'll wait for more people to join the broadcast. Well, Connie, if you can hear me, just type yes on the chat. That way I know if sound is coming through. Okay, I guess we can start right now. Let's start this presentation. Welcome to the live video for July for the Gamma Optimizer room. For those of you that are new, I welcome you. The whole point is just to go over what we have in terms of positions, what has happened recently, and what is my view of what will happen in the future. So let's start talking about the NDLA. No? This is kind of, I guess, the favorite of the room. So right now, NDLA, we are in a sea of red. It's just negative all over the place. If we look at the variance center here, we can see in the NLDLA Classic a full row of red signals, which means negative signals with a lonely green. And right here, this is the lonely green for the NDLA table. And for the 2.0, all of them are negative. No? So lately, the NDLA doesn't seem to like this area where the market is trading, and it has been generating lots of negative signals, and they have been more or less correct. Now, the negative performance of the NDLA Classic has been 75%, which is not bad at all. Yeah. Okay, so I have a couple questions. I am glad that you guys hear me. And second, yes, I sent another reminder to the room. They are coming, and there is always a recording of this video, so people can watch it later. Anyway, so NDLA has been negative for now, and for those of you that have been here long enough, you know that we don't trade negative signals. We only do the positive ones. It is tempting with a 75% success rates of the negative signal. It is tempting to negative trades, and we have tried. I remember that in the past we tried a couple ones, and they work fine. It's just that I don't like the risk reward. Although with 1.55 on the spread, it is starting to look good. If the spread goes really expensive, I mean, if the spread goes above 2.0, then I love it. Now 2.0, 195. We get a good amount of money for the negative spread. We might do some pure negative signals on the NDLA. Otherwise, just sitting on our hands, not doing anything. The performance of the net has been fantastic so far. At this point, NDLA 2.0 is still edging NDLA Classic. Even though I don't post those things, I can show right here. Let's see the stats for NDLA 2. I can generate the stats real time right here in this area of the screen, and you can see that NDLA 2.0 has been beating NDLA 1 on the last 20 days, and I think the last 42. Let's see. Well, they have been tied in the last 40 days, 50% and 71%. So it has beaten them in the last month, and in the last 2 months they have been more or less equal. No, But it's an interesting competition between the two NDLAs. I still favor NDLA 2.0. That's the one that is being favored at this time. It has better full precision, better partial precision, although it has generated very few signals in the last month, only 3 signals. So the recall is terrible. Recall has dropped to 25%, which means that it has missed quite a few moves. The recall of NDLA Classic seems to be really good at 62.5%. So I don't know, something to choose for. But at this point, it really makes no difference because there are no signals, there are no positive signals, so there is not much for us to pick, okay? Of course, for those of you that are also new to the live video, remember that you can ask questions at any time. I check the questions and I just type them on the chat window in YouTube, and I'll keep an eye on them. So that was the NDLA. The last thing I wanted to remind you is that even though we have a bunch of negative signals, it really doesn't mean that the market is going to fall. For instance, in the last week or two, we have seen the market has been very stable, kind of drifting up really slowly, kind of turning down slowly. So a negative signal is just that we are not going to see the upside move, but it doesn't mean that we're going to get a tremendous fall. So just to make that point clear. Let's take a look at the current positions. This is easy because we only have the butterfly. Yesterday, we closed the VRP trade and it worked fantastic. VRP is just a variance risk premium type of trade that we extracted. And it seems that we closed it too early. It was a little early. I was getting paranoid about the market. And you know me, I'd rather take the money and run. For those of you that are more patient and wait, the trade is 48 cents today to close, so much better than yesterday, much better returns too. So the question is, should we start more VRP trades? That's a good question. If you notice, this trade return between 13 to 15%, depending on where you enter, where you close. And so the performance of these trades is not stellar, it's not particularly noteworthy. It's just kind of 13-15% every week. It is not bad at all. I mean, it is not a bad type of trade, in particular for something that pays when the market doesn't do anything, no? But the question is, should we do that? I posed that question to the room, and you guys can decide if we should do more or not, okay? So far, the performance of the room, you can see we have here the only position that is open, which is just basically carrying it, because I think at this point it's more expensive to close it than to carry. This butterfly for September, time is running out for it to wake up. Look, it's at 0 right now. So, and in order for it to light up, market should fall substantially. So we have like a couple months, 2 months and a couple weeks for it to actually fall. We'll see if the market falls. In terms of historical trades, we have done really well since March, and the total performance, the total return of the room is around 98.5%. That's not a bad return, in particular because it's an ideal $2,000 account. So that's not bad. We are almost doubling the portfolio, the account size since March. And that's not a bad return at all. As I joked last month, this is a point where I will gladly close any hedge fund for the rest of the year and take the performance. But we'll continue. I'll continue adding things. I want to go back over 100% really soon. We'll see if we can do it. What else we have here? Let's take a look at volatility. So we have a collapse in volatility. Volatility has been collapsing daily and also implied. So look at realized variance has been extremely low. Okay, I have a question. Let me see what the question is. The question is, please one more bet like September butterflies in case mean reversion happens, as EWT analysis are hoping for it. It's better to wait and pay more. No, we could do some really cheap butterfly to play downside. I'll be tempted to play downside once volatility collapses more. So right now volatility is collapsing nicely. Sorry about this. It is 8% in the last month, 6% last week, and it's almost 7% last 2 weeks, and 7% last week. So 6.92 last week, 6 last 2 weeks, and 8 last month. The takeaway here lesson is that it's very low, that the market is slowing down massively, volatility is collapsing nicely, and this week it was extremely low, and we finally got a little downside action, not much. It is starting to wake up, but I don't think that that's the point yet. In terms of implied volatility, VIX is around 14, which is low, but it's not 10 or 9, extremely low yet. VIX 9D is, again, this is the weekly, the 9-day expected volatility in the market is only 13%. So even though we have low values, it's not a crazy low. I guess it refreshed a little bit with the drop that we have yesterday and a little bit today, but I am waiting. I'm still waiting a little bit more for the best point to enter into downside trades. If you notice in our positions, our downside bullets haven't worked really well. Look at this one right here, minus 0.1. This one was, well, it's 10 cents. The first bullet didn't work. I mean, we have tried 3 times and it has never worked. So this market seems to be only moving up and up and up. So before we try again, and we have this one currently going on and it's not working that well either. So downside trades, I don't think they work. And looking at the variance center, you can see this. You can see the market is taking off after hitting a little low around noon. They want to close it green today. They really want to do it. It seems that buying the dip still remains the operating mechanism for this market. Yes, just buy any dips. But we are having lots of red flags, I guess, going forward, and that's something that we have to pay attention to. Just a general comment here about the market. Remember that tomorrow we have monthly options expiration in SPX. That means that those options expire right at the open at 9:30 in the morning. They expire, and they have gigantic amount of gamma. If you look at the gamma imbalance here, let's see if I can highlight it. This is the gamma imbalance. If you look at the gamma imbalance, you can see that we have a massive amount, almost $30 billion in calls for 3,000, and we have almost $20 billion in imbalance for puts into 29.75 and 29.50. So there is a lot of imbalance, and the thing is, option dealers need to hedge the imbalance today because the market will close and then it's only until the open. So that's what you're seeing here happening today. Any of these moves, so this buy the dip is just from hedgers. Hedgers are the ones buying this dip. And once it reaches a certain point, you will see a lot of selling from hedgers too. So it's very interesting. It's going to be lots of hedging activity. It's going to pick up as the session nears the close. So I expect around 3:40, you're going to see massive amounts of hedging, and that hedging will be against the market. So if the market is trying to go up, there's going to be lots of selling, and if the market is trying to close red, there's going to be lots of buying activity. So more or less, I think the market might close flat today, but I don't know. There is too much gamma in those calls for 2,900, and when you see so much gamma on the strike, it becomes an attractor. I will not be surprised if they want to push it all the way to 3,000 again. So for now, I am flat. I'm happy being flat. I'm kind of observing the market, preparing for the impending collapse of everything. Let me see. I have a question. Any magnetic pull towards a particular price? Oh yes. So the pull will be, the easiest pull is 2,975. That's the easiest pull, which is 10 points down. or 3000, which is 15 points up. So we'll see what of these two is. It's an interesting bet. It's not much, 10 points or 15 points is just a small move by modern standards. And with the market being in the summer, with traders on vacation, with volumes really depressed, it doesn't take much to move the market 10 points or 15 points. So right now, I don't know what direction will be. Is the hedging effect limited to indexes, or are you seeing individual stocks as well? So it is, the hedging starts in the index, but it propagates towards the individual stocks, because an index at the end of the day is a basket, a collection of stocks. No, so if I am an index options dealer, I have to hedge, and usually you hedge with futures. Now, index options dealers hedge with futures, but futures need to be hedged with something else. So the future dealers will hedge with either SPY or the basket. So at the end of the day, the move will go options, futures, SPY, shares, or option, futures, and shares. So you will see this buying activity will translate into buying of the whole basket, and the selling activity will translate into selling of the whole basket. What else? Bob questions, I noticed that gamma imbalance is strongly up above the money and down below the money. Yes, right now it is, because it seems that the 3000 strike accumulated lots of calls. So there are lots of calls sitting in 3000, and funny enough, those calls are mostly short. So the people didn't buy those shares. So I mean, retailers didn't buy the 3000. Retailers sold the 3000, and so dealers are long the 3000. You see my point? So that's why the market is long gamma, because of massively long gamma there, and the hedging activity will be against the market. So as the market approaches 3000, there's going to be lots of selling from option dealers. Another question? Okay. No more questions. So let's come back to the presentation. What are my expectations for volatility? Okay. So summer is progressing. We are mid-July. And remember, back in June, my expectations were of very low volatility. Well, they had been fulfilled so far in July. They are unfolding nicely. That's why our VRP trade works so well. But I must say that there are dark clouds or red flags, whatever is the metaphor you want to use. They are accumulating in the horizon. The first thing is ambiguity. Ambiguity is really moving up. And when ambiguity moves up, we need to pay attention to it. So I'm going to show you what ambiguity is today. So let's compute ambiguity really quickly. Here you can see the graph of ambiguity to the right. I cannot select it, but you will see the graph. Sadly, I don't have pointer highlighting in this particular software that I'm using to broadcast. But you can see that ambiguity is getting closer to the same areas where we have seen downside in the market before. Now, so we have seen that every time that the market has moved down strongly is because we have been around the 0.35, 0.4 area. And right now it's around 0.3 something. Let's see. Right now is 0.31. So slowly, little by little, ambiguity is getting to the area where the market is going to reverse. And I will say that there is a good risk reward if we play the reversal. That will be a really nice play. So that's why that's kind of a dark cloud for the rest of the summer. Other things also on the horizon is that realized volatility has been extremely low, and a reversion to the mean is expected. It is, when it gets too low, it have to come back again. So that's something waiting on the market. Also, the GT level is marching up. That's a very interesting thing. Notice that the GT level is 2,935. And so it's catching up with the market itself. No? So GT level, market is up, but the GT level is also moving up. And if it catches with it some way, it's going to be an interesting reaction, because if we flip short gamma, remember, once we flip short gamma is when all hell breaks loose. Now the moves will be accelerated, and it's going to be interesting. So we have to pay attention to the GT level. And finally, we have a Fed meeting at the end of July. So we have the last 2 days of July, we have a Fed meeting, and anything can happen. You know that how that works. If we look at this, you can see that we have a bump in the term structure of SPX options, and you can see dealers are starting to prepare for the bump. Right now, they are not that worried, but you can see uncertainty is slowly creeping into the market. They are starting to bump up a little bit the term structure. So we'll see. We'll see what is happening there. Finally, short vega trades. Okay, so yes, we did the short binary triangle, what we call the VRP trade, and it worked really well. It looked like an iron condor. I know there are lots of you didn't want to do it because it looked like an iron condor. And yes, on the outside, you show this to someone else, they will think it's an iron condor. But the trade was really a short binary triangle. That's what the trade was. And the short binary triangle worked really well. I wanted to extract premium of the binary call and the binary puts. And because we don't have binary options, then we were replicating them with the spread. So that's why it looked like an iron condor. So I could do one, but given the clouds in the horizon, given the red flags that are developing, I think that it's better to do a short binary risk reversal. The risk reversal is a play that we have done before. We have an upper limit. So the thing pays until that limit and then we lose money. But then if the market falls, we get max gain. So it's kind of an unbalanced, construction. It's a construction that there is a cap profit to the upside and then it flips to loss. But then there is not quite unlimited, but there is a really good profit to the downside. So that's kind of the structure I'm favoring to play the upcoming apocalypse, the upcoming end of Western civilization. And just guessing will happen around the Fed meeting. So around the end of July is going to be the opportunity. We'll see. It's only a couple more weeks, so we can be patient. And finally, any questions? Just ask questions, folks. Don't be shy. Just tell me, ask me anything. Let me see what else can I look here. Okay, so the market is strongly moving up, and keep an eye on the 3,000 in the meantime. And let's look at what else. Well, no, that's everything that I have for you folks today. And if there are no more questions, then this is the end of the live video. And as usual, you can contact me in the room, you can send me a private message or post to the public room. I'll be more than happy to answer all of your questions. Thank you for joining me today. Take care, folks. Okay, I have one question. Since SPX seems to have started vertical takeoff, is cross good to short at 3K? No, I will not short at 3K. It is no, there is no reason to start a short right now in the market. So there is a good potential for a fall, but doesn't mean that there is a good statistical edge to shorting. And one of the reasons for not having a shorting, not having an edge, is that even though implied volatility is going up a little bit, like you can see in the cost of the vertical, it is still too low. Why do we want to short when volatility is so low? We are not going to get anything out of it. So remember, the market is still moving up. The dark clouds are accumulating, but it doesn't mean that it's going to reverse right away. To me, the best point to short, and I'm going to tell you right away the plan, if you really want to short this market, if you are dying to short this market, I will say wait until the GT level is hit. And you say, oh man, but it's like 50 points down. Who cares? If the GT level is hit, the market will drop probably 200 points. It's like if you weigh a few points for 200, it is worth it. But if this doesn't happen, the market could go really high. Notice that there is nothing on the gamma imbalance side. There is nothing about 3,000. It is almost empty. So there is plenty of room for the market to go up in terms of hedging, and any shorts will be toasted. So be careful. And again, wait at least until the GT level is tagged before shorting, and also wait for realized variance to go over 12%, the magical number. Okay, thank you folks. Have a great afternoon. See you later.